Hi everyone, good morning. So this is part two of Introduction to Debt, another episode in continuation of the previous one. So now let's discuss about the uses of debt in personal finance. Now, uh, let's try to understand this. If a student wants to study, or if there is a situation where a family wants to buy a house, or a company wants to expand, in all these three cases, the desire exists today, but but they do not have the money. So there is a desire, there is a desire, but when we talk about money, so they are falling short on the money. Okay, so this is where debt actually enters the story. Uh, Debt is not a villain, it's not a hero, but debt is actually a tool. And previously also we talked about it. Debt is just a tool, and like all tools, its impact depends on how it is used. So today we are going to walk through the entire journey of debt, how debt is taken, how it's repaid, how it becomes how it actually becomes a financial instrument, how investors, companies, and individuals experience it, and finally when debt helps, and when does it destroys value. So when does actually debt helps you, and when does it actually destroys the value which you are creating. So, okay, start today's session. Debt, good debt and bad debt. So, debt is just a tool. So, good debt actually builds assets, and bad debt actually funds consumption, and there is no further value or no future value. That's why debt is actually a tool. Debt is just a tool. It's not a hero, not a hero. Debt is not a hero, and debt is not a villain also. Understand this thing. It will deliver the result, and the results will depend on how you are going to use it. So how do we take that? Now let's talk about the how does the birth of debt contracts. So when we start, uh, let's do a step by step. Uh, let's understand this step by step. So when the need arises, the borrower's need arises. So every debt story starts with a need. A company's need to grow, company needs capital to grow, persons need to buy a house, and a person will be needing money to buy a house. Governments need to fund for infrastructure, and government would be needing fund for infrastructure, yes. And at this point there is no debt yet, only a requirement for the money. So desire for the growth, and you are falling short on the money. This is where debt comes into play as a bridge. So there is a lender and there is a borrower. So lender is someone who actually has the money, and borrower is someone who actually has the need for the money. So lenders will evaluate the credit worthiness. Now the lender steps into the story, and the lender asks one basic question: if I give you money today, will I get it back? And the answer to and to answer this, the lender evaluates the credit worthiness, which means the borrower's ability and willingness to repay the debt. So this evaluation usually look at the income, And the cash flows. Can the borrower generate enough money to repay? It evaluates the credit score. Credit score and the credit history means that has the borrower repaid debts responsibly in the past? And collateral. So if there is an asset, the lender can claim if repayment fails. So the step exists to protect the lender, but it also protects the borrower from taking unsustainable debt also. Credit score, income and cash flows, and collateral. The third step in the process of taking debt is terms that are agreed upon. So if the lender is satisfied, the two sides negotiate the terms here. This third step. So these terms define the entire character of the debt. The entire character of the debt includes the the characters are interest rate. So interest rate is the cost of borrowing. Tenure. Tenure means how long the borrower has to repay. And repayment method, how repayments or how the payments will be made back to the lender. And once these are fixed, the future path of the debt is largely determined. And the debt contract is signed. So once the debt contract is signed, now the most important moment, the promise becomes legal. Here, the promise becomes legal. The debt contract creates a binding obligation, specifies rights and responsibilities, and it actually defines consequences of default. So this is what separates debt from informal borrowing. And finally, the last step is the funds are disbursed. Finally, the money moves. The borrower receives the fund. The lender now holds a claim on future cash flows, and debt is actually born. So debt is officially born here. So debt is official here. I hope this much is clear to you. Now let's understand how debt is repaid. So once you have taken the debt, now you actually have to repay in smaller installments. So repaying the debt, we are talking about the terms agreed upon with this when we talk about repayment. So in the terms agreed upon section, we also talked about repayment method. So let's talk about how the debt is going to repay, how the borrowers are going to repay the debt. And debt does not have a single ending. It can be repaid in multiple ways depending on the structure. So the common repayment structures are amortized repayments, interest only, bullet repayments, balloon repayment, prepayment structures. When we talk about amortization repayment, so this is most familiar form. The borrower makes regular payments, and those are called EMIs, each month installment, and each payment include an interest and a portion of principal. And over time, debt gradually disappears, and this structure provides stability and predictability. When we talk about the interest only repayment, so here the borrower actually pays only interest for a period. Principal remains unchanged because principal is paid on later. And this lowers initial payment, but it actually pushes the risk toward the future, later into the future, because at the end you actually have to make a bigger payment. Principal, all of the principal is paid at the end. So throughout the tenure, you are only uh, paying the interest, but at the end, you actually have to pay the principal back. The third repayment method is bullet repayment. And in this structure, no principal is paid during the tenure of the loan, but the entire principal is repaid at maturity. And this is common in corporates and market debt. High efficiency, but high refinancing risk also. It's highly efficient, but there is also a high refinancing risk. This is common in corporates and market debt. The fourth common repayment method is balloon repayment. It's a hybrid structure. In a balloon repayment, there is a small or partial repayment initially and a larger or a large final repayment at the end, just like interest and bullet repayment structure. But there is a difference in between all these three. We will talk about the difference later on. As of now, just understand this. A balloon repayment, a larger final repayment is paid at the end of the year. It looks affordable early, but it can be dangerous if the cash flows do not materialize. And the final structure is prepayment. So sometimes borrowers repay early, and this reduces actually the interest cost. But the lenders may charge prepayment penalties, and prepayment transfers risk from borrowers to lenders. The next we are going to discuss about what are debt instruments. And so far, debt has existed between two parties. But modern finance actually goes further. Debt can be packaged, standardized, and traded. And that's what debt instruments represent. So the definition of debt instrument is a debt instrument is a financial contract that represents debt and can be held or traded. In simple terms, a debt instrument turns a private loan into a market asset. The type of debt instruments which are available in the market, and I'm sure that you are also familiar with these instruments. You might have heard of these instruments. So the common debt instruments are loans and bank loans, term loans, syndicate loans. These stay on the balance sheet of companies. Uh, Another type of debt instrument is bond. So bonds could be, these are tradable instruments, which are government bond, corporate bonds, municipal bonds. These can be bought and sold in the market. Then there is money market instruments, which are short-term instruments, treasury bills, commercial papers, certificates of deposits. And then there are debt structures. So debt structures are asset-backed securities, market-backed securities, and debentures. If you're familiar about the 2008 real estate crisis, and there is one movie about it also, The Big Short, I will recommend you to watch this movie if you want to understand uh, a better understanding of these securities. So that structure that actually involves pooling and structuring cash flows. Money market instruments are used for liquidity management. Bonds, because these are tradable, these can be bought and sold in the market. And since the loans, the bank loan, term loans, syndicate loans, these are not tradable. These stay on the balance sheet. That's the basic difference in these all these debt instruments. When we talk about the structure of the debt instrument, so early debt instruments follows a blueprint. The key components include the face value. The face value is the amount that is going to be repaid at maturity. Face value or the par value. We will discuss about this in detail when we will talk about the bonds. And I actually have prepared a lecture for that also. So the fixed income universe is that big that I initially I did not had any idea to where to start from. But so that's why I actually started from the basic, the debt part, and slowly and gradually we will discuss all the other parts. So let's get back to the what we are discussing, not digress from the topic. So face value is the par value, which is the amount to be repaid at maturity. Coupon rate. Coupon rate is just like interest paid on the face value, interest paid, and it's interest rate paid on the face value. Coupon frequency is how often the interest rate is paid, monthly, quarterly, semi-annually, yearly, annually. So that's coupon frequency. Maturity date is when principal is returned. Security or collateral. This means whether there is any asset backing the debt or not. Seniority. Seniority, when you hear about seniority, it's priority on repayments. When we talk about debt, equity, preferred equity, and we talk about common equity. So you guys know, we have discussed this previously in the previous episodes. So debt actually have a prior claim over preferred equity, and preferred equity has a prior claim over common equity. So debt is senior and seniority decreases when we go from debt to common equity, because equity represents the ownership and debt does not represent the ownership, but the ownership and high risk. Debt represents low risk, but for that low risk, they are compensated by seniority. So if something goes bad, if something goes wrong, so debt holders will get priority in repayment. So that's the basic definition of seniority. How does seniority, uh, if I had to put senior these the term into words, this is what seniority represents. Then we comes to covenants. So covenants are nothing just but the rules that borrowers must follow. It's just a fancy name for terms and conditions. The next point is the call or the put option, right for early redemption. Call and put. Call, simply call means you can buy, you have a right but not an obligation to buy. When you say put, you have a right but not an obligation to sell. Understand this thing? Right, but not an obligation. And here also right, but not an obligation to sell, to buy. Call and put. So that's a right, but not an obligation. That's a right and not an obligation to sell. We will discuss about these things when we will talk about derivatives in the further readings. Mm. Uh, so just when we talk about this, since we have, that's why I'm giving you a definition. So when we will discuss about this in the future readings, this will actually trigger this obligation, right, but not an obligation. So this is a right. You actually have a right, but there is no obligation to buy something. That's call option. You have a right, I'm giving you a right to buy it, but there is no obligation to buy it. If you want, you can let that uh, option expire. Okay. So I hope this much is clear. The key structural components of a debt instrument. So these elements actually define the risk return in the behavior, and that's why it's important to understand the key structural components. Now, fixed income securities. So fixed income securities are debt instrument. These are those debt instruments that provide predictable cash flow. So fixed income is actually why they are called fixed, because the interest is known in advance, because I know how much interest I'm going to get, and I know that the principal repayment date is defined. So I know when I'm going to, how much interest I'm going to make, and I know how much principal, and at what time I will get my whole principal back. And that's why it's called fixed income. And the examples include bonds, debentures, notes, treasury securities, and these instruments form the foundation of pension funds, insurance companies, and conservative portfolios. And the type of fixed income securities are defined by issuer, by coupon, and by risk. So types of fixed income securities are defined by issuers. Uh, So, so the fixed income by issuer, these are government securities. Those are the risk-free securities, corporate bonds, financial institutions bonds. You can define the fixed income securities by coupon also. So there's a fixed rate bond, there's a floating rate bond, and the zero coupon bond. You can define the type of fixed income security by risk also. So it's a high investment grade bond or it's a high yield junk bond. So each category actually exists to serve a different risk appetite. When we talk about, okay, let's start with debt instrument and investors perspective. Let's talk about this for a, try to understand this. So investors perspective, investors buy debt for stable income, capital preservation, lower volatility than equity, and predictable cash flow. But they also faces risk, credit risk, interest rate risk, inflation, liquidity, and reinvestment risk. And for all these, they need compensation. And this is how the interest component is calculated after considering all these factors, or the coupon rate. When we talk about debt instruments, we just talked about this coupon rate. So both of these terms represent the same thing, but this coupon rate is used in debt instruments, and this interest is used in another type of loan, another type of debt. In basic terms, it's interest, and when we talk about, if we go a little technical, so we will use coupon rate. From a company's perspective, so from a company's perspective, debt is actually a financial tool, a leverage mechanism, or a tax optimization strategy. Why? Because when you use debt, so there is a tax advantage also, but also there is a fixed obligation, a potential for bankruptcy trigger, and that actually magnifies both success and failure. You actually have to uh, use debt very diligently. And from an individual's perspective, it actually enables asset ownership, smoothens income over time, and can accelerate wealth creation, or it can trap them financially if uncontrolled. And the rule of thumb is use debt to build assets, not lifestyle. And the the final topics of this introductory reading. I hope uh, you are able to understand where I am directing you. So should we prefer debt? The next question is, should we prefer debt, and why debt is attractive? Because it's the payments the payments are predictable. There is a lower cost than equity. uh, there is no ownership dilution, stable income for investors, and there are tax benefits for borrowers. And why debt is dangerous? Because fixed because there is a fixed obligation regardless of income. There is a bankruptcy risk, there is interest rate sensitivity, there is inflation erosion for the lenders, and if there is over leverage, it is going to destroy value rather than creating value. Everything is explained in this table. When debt is good and when debt is bad. So good debt, when we talk about good debt, funds income generating assets. So good debt is that debt which actually funds income generating assets. Good debt is that debt which is affordable when it comes to repayments, and a good debt is that debt which helps us to generate cash flow. And if we are able to match the cash flow with the payments, then it's a good debt. When does a debt becomes a bad debt? When it actually funds the consumptions, when it when the interest rates are high, then it's a bad debt. And when there is no prepayment capacity, the debt is going to be a villain for you. And in the initial start of the lecture, we discussed that debt is not a hero, not a villain, but it's actually a tool. It will give you the results as you use it. So if you use it in a good way, it will going to give you a good result. And if you use it carelessly, it's going to give you a bad results. So at the end, so to summarize all this, debt is not the problem. Misunderstanding debt is. And if you use it wisely, debt actually accelerates growth, enables opportunities, improves efficiency. Used carelessly, debt actually amplifies mistakes, destroys the stability, and ends financial stories abruptly. And in the coming lectures, we will dig deep into bonds, yields, duration, credit risk, securitization, and tranching. But today, remember this: debt is a story about discipline, time, and responsibility. Uh, if you are still having any doubts, you can post your doubts in the comment section, and I will be happy to answer your doubts or your questions. And that will be all for today. So thank you for attending this lecture, and I will see you in next lecture where we are going to discuss about the bonds part. Thank you, everyone.